So this is the fourth video in 3 weeks since China's bazooka moment. So market participants like myself are probably all at the edge of our seats, waiting diligently from the various briefings, announcements from the different ministries and authorities, talking about or outlining their plan and how they intend to arrest the cornucopia of issues plaguing the Chinese economy today. And truth be told, I'm also getting a little bit tired following with these various developments. So huge disclaimer, nothing said in this video should be construed as any form of financial advice. All opinions expressed is my own. I'm not a macro expert. This is not even for educational purposes because your guess is as good as mine. And please exercise and conduct your own due diligence. But back to the point, I think there's a huge surge in demand around the Chinese stocks and macro environment today. People just wanting to know what exactly is going on, specifically around this huge volatility. But for myself, I don't necessarily want to churn the content wheel because I do understand several creators out there, they are riding on this recent bandwagon and they are talking about it daily, speaking about the various implementations, macroeconomic policies, what are the specific consequences, so on and so forth. For myself, I don't pledge to be a China guru. I'm just a fellow observer and a fellow investor. But I just so happen to follow the Chinese story and development a little bit longer than some of you. Therefore, I do have a little bit more context and also skin in the game. So the last I checked, with regards to my educational background in the world or realm of economics, so I did take the economics subject at a JC level, doing A-levels in Singapore, some 8 years back. And I think I did okay. My English is also not too bad. I think my Chinese was also passable. But that's besides the point. Because I think the bigger, broader concern here is really I don't identify and I really am not an expert in a lot of all these macro discussions. So inevitably, I really have nothing much to say. I don't have an opinion in every subject matter. So moving from here on, I'll probably only update when there is something more substantial. And I think we have veered quite a fair bit over the past 2 weeks. And I must admit, I also started consuming a lot of all these macro-related content. So I'll go back to my good old securities analysis, portfolio investment philosophy, or psychology, and other non-macro stuff after this video. So I'm sorry to disappoint those of you who are interested in getting daily updates around the Chinese market, but that's not necessarily my cup of tea, at least for now. So before we dive deeper into the briefing specifics, I'm not going to lie, I'm a little bit scared. And here's why. So before the whole stimulus conversation got going, I did upload 3 specific videos talking about it after the announcement. And pre that announcement, just 1 day before, I uploaded this video with the title, Why I Still Have 64% Invested in China Stocks, and clipped in a very pessimistic remark coming from a long-term China bull, which is Ray Dalio. Published them on the 23rd, 27th, 30th, and the last one, which I published it on the 8th, right before the Golden Week reopening. And I did caution fellow investors or traders talking about how I'm uneasy about the whole China stock market hype. So, and to put things into perspective, this was when the videos were being released and how the Hang Seng Index, which tracks the broader Hong Kong market in general, how the stock market has performed. And I don't know to whose credit, clearly I don't have any insider information, but right after I uploaded the video on why I still stay invested, that was when we had that Tuesday briefing and the Chinese and Hong Kong market went on to this absolute tear the following 2 weeks. And during this period, it was basically the Golden Week holiday. That was when the A-shares China market was closed. And in that particular season, I've been consuming a lot of content with regards to how people are extremely bullish about the Chinese stock market. And that was when I released this video talking about how I'm uneasy. And true enough, on that Monday, right after the market opened, we had that huge 9-10%. So to test out this theory, I'm going to name this video with a stronger bullish tone, despite many of the disappointments coming in after the Saturday briefing or meeting. And let's see whether the stock market will close green on Monday. But anyhow, this was the biggest talk in town where we had the Ministry of Finance giving a Saturday briefing. And this was a summary from the South China Morning Post. And there were 7 major takeaways. So the headline policy announced by the ministry's conference were as follows. They allocated 400 billion yuan from the local government debt balance limit to expand local financial resources. They're going to tap funding from an unused bond quota of 2.3 trillion yuan. They introduced a one-time large-scale debt ceiling increase. They're going to allow local government to use special bond to purchase idle land. They're going to use special bonds to purchase existing commercial homes. They're optimizing tax policies, and they're going to double the quota for college student subsidies. And long story short, what's my own personal summary or takeaway from this? To be honest, I don't really know, and thanks for tuning in. So jokes aside, I really do not have a very strong opinion about this, but I guess Zhang Zhiwei, who's the president and chief economist of Pinpoint Asset Management, offered his view. He said that the press conference didn't give a specific number on fiscal stimulus, and the key messages are that the central government has the capacity to issue more bonds and to raise the fiscal deficit, and they plan to issue more bonds to help local governments pay off their debt. So although the minister didn't explicitly state the deficit would be raised, but they imply an increase above the 3% threshold next year. So this would be a meaningful shift of the fiscal policy stance and help boost domestic demand and mitigate deflationary pressures. So on the aggregate, based on what I've read across multiple media sources, I think it's safe to say that most analysts or investors are pretty disappointed because there's not much clarity and confidence that's going to continuously support this second leg up. But that's of course based on the preliminary survey amongst these different Western side analysts. So from a more bullish point of view, Hao Hong did tweet out saying that you want to discuss the specific numbers, and the reply was not now. So at today's presser, China's Minister of Finance whispering with his deputy. So this was one of the most striking moments. It suggests that specific numbers of the fiscal stimulus had been discussed and are in works. Before it can be discussed in the public, it must be approved by the People's Congress. So this cliffhanger arouses intense market attention, leaving the market waiting on its toes. Overall, today's presser is steady as she goes, with some insights and forward guidance. It avoids being tied up by a specific but completely meaningless number set up by social media. Secondly, we have the perspective from Kathy, where she said that this could be something. One of the major reasons that local governments have been holding back on debt and investments this year is the pressure to reduce their debt. And based on the summary, the minister did allude that the central bank's balance sheet still has a long way to go, and they are now focused in trying to pare down the debt levels of the local government and also to increase significantly the current debt ceiling. So on the more bearish front, there's this notion that there is no new stimulus specified to incentivize consumption, which has been a weak link in the economy, and no specifics on subsidies for household either. And while the local governments have 2.3 trillion yuan of funds from special bonds that they can use by the end of this year, this is not fresh stimulus, as that comprises bonds that have been issued but not yet used. And a second perspective offered by Mr. Dracula, saying that the Chinese market didn't have a good day on Friday, but I would suggest Monday will be much worse. So the Ministry of Finance conference today delivered little, and in fact likely increased the amount of concern for banks and the LGFV health. So LGFV would suggest the local government financing vehicle. So previous stimulus included demand-side initiatives that are really just supply-side measures. So today seem to concentrate on repairing capital for state banks and the LGFVs pledging to resolve problematic hidden debt, which isn't exactly a good news story. These again are just supply-side measures and not demand-side. So for local governments, an unused bond quota of 2.3 trillion will be used to make up for revenue shortfalls. So special bonds for home repurchases and acquiring idle land for developers in trouble, again, more supply side. In regards to targeted measures to boost consumption, there was nothing concrete given, with promises relating to fiscal room to implement. So in general, on the aggregate, I think Mr. Dracula's perspective is the primary concern amongst investors today. So here's what I don't like about the Chinese market today. There's too much macro talking, it's very sentiments driven, and there's a lot of noise. You as a retail investor might feel like you're armed with the right knowledge to make the right decision, but personally, I beg to differ. By now, I think you should know that the market don't work in a predictable fashion. And from Howard Marks's It's Not Easy memo, here's what I would like to quote. So second level thinking is what immediately pops into my mind when I think about Charlie's observation. Anyone who thinks it's easy must be a first level thinker. So let me use some simple examples. So first level thinking says, it's a good company, let's buy the stock. Second level thinking says, it's a good company, but everyone thinks it's a good company, and it's not. So the stock's overrated and overpriced, let's sell. So the bottom line is that first level thinkers sees what's on the surface, react to it simplistically, and buy or sell on the basis of their reaction. They don't understand their setting as a marketplace where asset prices reflects and depend on the expectations of the participants. So they ignore the part that others play in how price changes, and they fail to understand the implications of all this for the route to success. Simply put, I think this current sentiments-driven, macro-driven Chinese market is very, very noisy. And many investors on the sidelines trying to take into account many of these sentiments-driven and numbers, 2.3 trillion versus 5 trillion versus 10 trillion. I don't know how they're going to make the decision effectively. And I dare speculate that no one in the market currently knows what's the actual impact of the X trillion dollar stimulus that's going to come to the Chinese economy and how it's going to trickle down to the stock market in general. And that's why I've been sitting back and just holding off any discretionary decision over the last 3 weeks or so. So I too have been swayed by many of these data points that are popping out of nowhere. And personally, I find it hard to incorporate many of these macro signals into my thinking and decision-making process. So here's my guess moving forward from here. I have my own theory, but please take it with a big bag of salt. So the bottom line is this. I think we'll end higher in Q4 of 2024, and this bull market is here to stay, at least until next year, barring any black swan. So I have been following the Chinese market for more than 3 years now, and I can appreciate the change in tonality and posture from many of these government regulators and how they look at capital in general and the stock market. So I do believe that we are in the next phase of the economic cycle where easing and expansionary policies are being rolled out slowly but surely. They've implemented something historic where they're putting a floor to market expectations and valuations, signaling that the Chinese government have some sort of a pain threshold as well. So once they start, I don't think they can stop. If not, a lot of their prior efforts will be wasted. So the government is not obliged to push the stock or property market up, but instead, they are intending to stabilize it. So don't go in with the idea that it's a sure win since the government is on your side. And I think to adopt a Western philosophy, which is don't fight the Fed, but don't think the Fed is your best friend. So the important fact here is that they want a slow and sustainable bull run. The keyword here is slow and sustainable. They don't want extravagance, they don't want crazy leverage. And it comes from the painful lessons from the previous episodes of the 2008 and 2015 crazy rally in the A-shares market. So they definitely also don't want market participants to think that this is an easy rally. Everybody can come in, get a quick 20-50% and then just get out of the market. And they have to restructure expectations moving forward from here. So I do expect the markets to be choppy, but I don't expect to see this sort of huge red candles like negative 9% that we've seen in the Hang Seng Index consecutively. And I don't believe they will go under 3,000 points for the Shanghai Index and under 18,000 from the Hang Seng Index for 2024. But of course, that's my own guess and my own opinion. So here's the thing. 1 week after record hedge fund inflows into China, we get record outflows. And the world's second largest economy has become a meme stock. So half the gains from China's bazooka wiped out in an hour, and that's China for you. I do stand by my opinion that I don't think we are going to see a huge bear market again from here on. And just a quick plug for new users to Moomoo. You can get to enjoy a starter kit worth up to 1,034 Singapore dollars. And all you have to do is to fulfill a few simple steps, such as depositing a minimum amount and to complete a few buy trades. And you get to enjoy a few stock bundles worth up to $567. And on top of that, if to complete the first subscription to Moomoo's Cash Plus, you can get 6.8% per annum guaranteed return for the first 30 days. And it applies to the first 80,000 of your holdings. And more importantly, given this huge volatility, for those investors and traders that want to take advantage of the Hong Kong stock movement, for new users, you can now open a Moomoo Singapore Universal account to get Hong Kong stock 1 month commission free card. And for existing users, you can grab your 1 month Hong Kong commission free trading card from Moomoo. All you have to do is to just click on me, promotions, my rewards, and you can claim it. Simple as that. So I'll end off with this post. So the recent move of the Chinese market is a rare combination of 3 factors all present: low valuations, revision of earning expectations, and the decline of the risk-free rate. In a broader sense, this is not a simple rebound from being oversold, but a reversal or re-rating of China as a country, China assets, and China as an investable market. So the key to the Chinese stock market is the medium to long-term sustainability of qualities on the fundamentals. Data are more important than ever. On a weekly basis, it is the supply and demand of funds. On a monthly basis, it is the fiscal or other policies. On a quarterly basis, it is the company finance-specific and fundamental indicators. And on an annual basis, it is the spirit of entrepreneurs and innovations. So we are more focused on the latter two. So how high and how far the market can go ultimately depends not so much on how trillions of special treasury bonds and fiscal deficits, nor on next year's economic and profit growth, as fiscal stimulus can have diminishing marginal effects. The core factor is how China can regain and rebuild trust and confidence by motivating and mobilizing the whole household sectors as well as the private sectors. So the degree of this success determines how far and how high the Chinese asset prices and valuations can go. So the medium-term logic is clear: to revitalize the economy with all might to end deflation. Whether you're optimistic, cautious, or unclear about the long term, the current market uplift is strategically the best opportunity to be long on China and to participate its drive to quality growth for generations to come. And this is a LinkedIn post from Qing Xiao, the founder and managing partner at RateGate Asset Management. She's someone that I follow very closely, and I'll leave the link to that LinkedIn post in the description box down below. It's a much longer post, but I've just essentially extracted the essence. So moving forward from here, like I alluded in the earlier part of this video, so I'm not going to continuously beat the dead horse and to talk about the macro conditions and situations. So I might make a video from time to time to update the very seismic and substantial policy or macro changes. But I think moving forward, I'm just going to go back to my good old securities analysis, investment philosophy, portfolio allocation, and just companies in general. So I do find myself getting caught up by many of these macro analysis, and I'm going to put a full stop here and I'm going to pull myself back. But with that, I do hope that I make my conclusion and bottom line pretty clear. I do think that there's still legs to run, and I'll see you in the next video. But more importantly, I'll finally see you guys on the moon. Goodbye.